Retire Plugged In, issue number 16. Your retirement date triggers two forces you can't ignore. This is the real truth about retirement. In newsletter number 15, we discussed Social Security as part of your plan to cover basic expense and operating expense in retirement. Your retirement date may or may not be your Social Security claiming date, but it will stop the accumulation of credits to your Social Security in probably your highest earning years. Can Social Security even come close to covering your basic and operating expenses? Well, that depends on your expenses, your claiming age, whether you're married, and what your salaries were while working. For those who have had high salaries, they may reach the limit Social Security will pay. So, what's that based on? There's currently a maximum salary subject to Social Security taxes of $184,500, which seems high until you look at current executive salaries. Also, if we look back 10 years, in 2016, it was only 118,500, a common salary for college graduates at that time. What did you earn in 1985? Was it more than 39,600? You can see the history of what the maximums were and see that you probably exceeded it many times. We have many clients who earn more than that maximum and will have federal pensions. The average worker will reach that maximum at least on average 20% of their work life. What's the maximum Social Security an individual could collect in 2026? At age 67, that's full retirement age for most people, it's $4,207 a month. And at 70, it's $5,181. Notice the almost $1,000 a month difference. That pretty much holds true for all levels of collection. That's a $12,000 a year more that you could collect every year in retirement. So if you can, suck it up, Buttercup. You can wait 3 years to collect. You could potentially provide over a 25-year period. Remember, this is for you and your spouse, longevity. You could potentially collect an extra $300,000. Plus, don't forget, you get cost of living increases almost every year on that. What happens when two married executives hit the maximum? We're talking at age 70, if they waited, and in their line of work, they probably could, they'd collect $10,362 a month, well over $100,000 a year. Now you're probably saying, sure, Nora, good for them, but that's not my situation. You're right, that's not the situation for the majority. However, if you're reading this newsletter, there's a good chance you're not far off from that if you learn how to structure your retirement. Then let's add in those who have a military retirement, military disability, federal retirement, and Social Security. Those are the fortunate retiree couples, some of whom we know who have over $250,000 a year in retirement income, all from the federal government, guaranteed for the rest of their life with cost of living increases. You might think, well, they're set. They don't need any planning. You would be wrong. Remember in issue 14 when we spoke about BODE, not just basic and operating expenses, but also discretionary and entertainment. It's all about the lifestyle you want in retirement or you plan for. They probably spend that much. Then, when one passes away and the other loses a Social Security check and half of those pensions, they don't know what to do. This brings us to why when you retire is so important. You can't just think about the first day of retirement. You have to plan for longevity, inflation, illness, taxes, and if you're married, spousal survivorship. For example, retiring at 62 instead of 67, or having your Social Security delayed until 70, may mean fewer Social Security credits, a smaller monthly benefit, actually 32% smaller, and more years relying on your savings. Let me ask you, if you could lower your taxable income without lowering your income, would you be open to doing it? Of course, most people give a resounding yeah. Then let's look at why when you collect Social Security matters. The right claiming strategy may help lower your long-term tax burden and better protect your family during survivorship, especially if your spouse passes away before you. Do you recall from newsletter 15 that at most only 85% of your Social Security is taxable? Let me clarify that. That's federally taxable. In all likelihood, your state does not tax your Social Security. There are only 8 states that tax Social Security to some degree. 42 states do not tax it at all. And here we have a map of which states. What does this mean for your retirement income? It means every Social Security dollar is from 17% to 30% less taxed than other income streams, depending on where you live. Your net income from Social Security is worth more dollar for dollar than your income from pensions, retirement accounts, investments, or most any other source. Wouldn't you want to maximize the dollars that are worth more? But Nora, I'll have to take money from my retirement account. I've worked so hard for it. If I delay Social Security, I have to take money out. Oh, that's true. And delaying isn't the right answer for everyone. Consider this short video about which horse do you ride waiting till 70? Do you ride your retirement assets or do you ride your Social Security? Which horse do you ride first? That depends on you. Remember, in issue 15, when we said not only does your Social Security grow by 8% a year while you're delaying, but you also getting cost of living increases that have averaged 2% a year. I doubt any of us can guarantee a 10% plus return on our investments or that they'll last our entire lifetime. However, not everyone has a retirement account large enough that they can afford to pull from a retirement account and delay Social Security. And consider those who may be less fortunate than you. Leroy and Martha worked many different jobs throughout their lives, but none of them paid especially high wages. Leroy eventually owned his own little company cutting lawns. Martha worked at a small nursing home as an aide. They paid into Social Security and lived within their means, but 401k plans were not available to them. Even if retirement accounts had been an option, Martha and Leroy could not have supported their family, avoided debt, and contributed to those accounts at the same time. Instead, they were careful with their spending, avoided credit card debt, and eventually paid off the home they lived in for 30 years. Though Martha stayed home with the children and only worked for about 10 years, they did accrue almost $100,000 in the bank. They didn't dare put that money into a retirement account. They couldn't tap in an emergency. Should they live off their savings and delay Social Security? Absolutely not. They may need those savings. However, if one of them, preferably the one who earns the most, can continue in a job that isn't too taxing on their body and delay retirement until age 70, their future retirement, which could be another 30 years, would be more secure. As it turned out, Leroy had people who could do the hard physical labor, so he could keep on going in his little business. Why would it make a difference? This couple learned to live within their means. And the good news is, depending on their needs, their retirement income from Social Security alone might be enough. What do they need to know about Social Security? First, if Martha takes her Social Security at FRA, full retirement age, it may be very small due to her low-paying job and fewer working years. However, if she does collect at FRA, she'll never have a reduction on her benefits. And if Leroy can wait until age 70, then collect, Martha's benefits will step up to half of what Leroy would have collected at FRA, which is much more than her full retirement amount. And more importantly, When one spouse passes, the survivor gets to keep the larger Social Security. Since they're dependent almost entirely on Social Security, it's important to make the larger check as large as possible. You may recall stories about your grandmother and grandfather who didn't pay taxes on their Social Security and wonder why you have to pay taxes on it. If you go back to issue 15 and the explanation of provisional income, you'll understand. Leroy and Martha may receive their entire Social Security checks tax-free because of their provisional income. Totally avoiding all taxes on their Social Security means increasing their net income to live comfortably. Additionally, they may qualify for Medicaid, avoiding Medicare premiums, and in many states and counties, their lower income and assets may qualify them for an exemption from real estate taxes. Who's going to guide them through this? No financial advisor will take them as clients without assets to manage. That's the purpose of our membership and this newsletter. You may wonder why I bring up what seems like an extreme low-income case to you. I share this because not everyone reading this newsletter has the same financial advantages your family may have. You may know someone who needs guidance but cannot afford to hire an advisor, or perhaps it's a church member, your lawn service, or your cleaning lady. This is another reason we're creating our membership site, Retire Plugged In. Our membership is for everyone, especially those who can't afford an advisor or those with much retirement accounts who manage their own investments and don't want to pay one. The basic membership will be affordable for everyone, while the higher levels will be robust in what they offer. Perhaps you're thinking, luckily, Nora, we have a significant retirement account. We're not in Leroy and Martha's circumstances. How do we know whether to delay collecting? That's why I inserted the video above. Depending on your circumstances, delaying at least one of a couple's Social Security checks may be right for you. But you just said they're worth more, so why delay one, not both? Well, remember, when one spouse passes away, the survivor gets to keep the higher one. Meanwhile, collecting the lower one at full retirement may help defray expenses, so we spend less of our retirement account. This may not be the best fit for every couple, but it gives you an idea of what the planning might look like. We really want that bigger one to be as large as possible because it's less taxable than any other income the survivor may have. A widow or widower will suffer higher taxes with the widow's penalty, and likely their Medicare premiums will increase. But the expenses don't actually reduce by very much just because you're alone. We spoke about provisional income with Leroy and Martha, who were dependent on Social Security. What if you have a large IRA and need more supplemental income from it because you lost your spouse's Social Security? Remember, inflation can also turn a comfortable budget into a tight one over time. A health event may have added unexpected medical or long-term care costs. And when one spouse passes away, the surviving spouse will lose one Social Security check and part of a pension, while many household expenses stay the same. Then let's add to that the widow's penalty tax. Yes, if you're now a widow or widower, your tax rates will jump significantly, and most likely your Medicare premiums, just when your income goes down. If that's your situation, how would the provisional income calculation affect you and your spouse while you're both collecting Social Security, then you or surviving spouse if left alone? Let's look at Ed and Kate as an example. Ed and Kate need $90,000 a year to be comfortable. Now, they each collect $30,000 a year from Social Security, and they take $30,000 out of their retirement account. Their provisional income is fairly low. However, when one passes away, the effect of taxes could be devastating, and we have a short video to explain that. Let's get down to the nitty-gritty of retirement planning for the family and how Social Security really works. How do you know whether to delay? That's where a fiduciary and the correct information come in. As we stated in the beginning, your retirement date triggers two forces you can't ignore. Force number one, Social Security decisions over which you have control. I hope this newsletter alerted you and gave you a better understanding of force number one. When you retire matters because Social Security is a large part of most people's retirement. Force number two is sequence of returns during your first 5 years of retirement, over which you have no control. We all hear that we should ideally prepare for retirement about 5 years in advance, which directly affects your Social Security choices. But who told you that the most important years in your retirement are the first 5 years? Next week, we'll address force number two, triggered by your retirement date. Sequence of returns over which you have no control. This will be the 5-year retirement window that changes everything.